On this show, we have discussed the relationship between the 10-year constant maturity treasury rate, or CMT index, which is used in part to determine the HECM's expected rate, and the Federal Reserve's Fed funds rate. Now, since the Federal Reserve cut their benchmark interest rate on September 18th, the 10-year constant maturity treasury rate has actually climbed from 3.7% to 4.2%, a jump of 50 basis points. However, as Dan Hultquist mentioned in a recent Housing Wire column, he says that the HECM is currently still offering interest rates that are much lower than the home equity lines of credit, or HELOCs. Now, if there is one thing that we do know, is that there is much uncertainty in our nation. Now, increasing unemployment, reduced consumer spending, and the wars in the Middle East and Ukraine, all of these have now come into focus, but also against a backdrop of a highly contentious presidential election and the uncertainty that brings as far as our policy. Long-term treasuries and bonds do climb, which happens when interest rates fall. But that's also driven by market expectations of a slowing economy, potential recessionary fears, or a central bank that has signaled future interest rate cuts, which the Fed has. And that is causing investors to seek the safety of government bonds, thereby increasing demand and pushing prices higher. Since last Wednesday, the 10-year CMT index for the HECM has climbed more than 40 basis points since October 1st. Now, analysts expect that treasuries and bonds will continue to climb throughout the remainder of this year, albeit modestly. This week, we bring you our monthly installment of Reverse Market Insights, Market Minute, to give you all the latest HECM trends when it comes to origination. We have with us John McHugh from RMI. John, what do you have for us this month?
Well, thanks, Shannon, for having me back again. Really appreciate this opportunity as always. So this month, we're going to speak about August now that those numbers are all final and we have more detailed information around those August numbers. As far as case numbers are concerned, because that's where we always like to begin these segments, is case numbers, because this is always going to give us our best prediction of what we can be looking at for the future. So August case numbers rose by 7.1% to 3,683 case numbers, while new equity takeout also gained 6.5% to 3,019. Now, purchase actually dropped 19% to 175 applications, while refinances had its third straight gain. In August, it actually increased 25.7% to 489 case numbers. So between what we're seeing with the increase in case numbers, as well as my conversations with loan officers, it's pretty safe to say that interest has certainly picked up in the product. We also see that with the reductions with rates, that refinances continue to tick up again for the third straight month. However, with rates inching up, I would suspect that in the coming months, we actually might see this number drop again. And finally, after our massive increase that we had in July with HECM for purchase numbers, we did see those, saw those numbers move lower, but we're still at normal levels as far as the purchases are concerned. Overall, endorsements for August, they dropped 3.3% to an even 2,200 loans. 5 of the regions are actually up in August, with New England grew 21.7% to 101 loans, where Great Plains added 9.8% to 45 loans, and the Southeast Caribbean was the largest region to actually rise, and it was up 6.2% to 512 loans. And after a nice increase last month with the wholesale broker channel, we actually saw it give back some of its gains, dropping 6.6%, and retail dropped ever so slightly at 0.6%. However, these drops were predictable if we consider the application volumes that dropped in both May and June of this year before they started to rebound here in July. As far as the top 10 lenders are concerned, 4 of the top 10 showed growth, with FAR rising 12.1% to 566 loans. Guild added 10.2% to finish with 65 loans, and Mutual kept the race for number 1 really tight, gaining 5.8% to 550 loans. Which is just a few short of FAR for the month. Longbridge inched up 1.7% to 423 loans. So from a case number perspective, August was actually great in comparison to the rest of 2024, but endorsements lagged due to declines in case numbers both in May and June. We already know that September endorsements also dropped a little bit from August, but with the increase in July and August case numbers, I'd suspect that we should start seeing endorsements begin to climb again in the coming months. Even with rates inching higher, we're seeing renewed interest out there. So don't focus or wait for these rates to drop, as you don't have any control over this anyways. So instead, just continue to prospect and help those borrowers. You can help now, but make sure you're working those CRMs as rates shift. This is where you're going to go to find your clients. So just tune in next month to see greater detail as to what exactly happened in September. And let's see if we can keep the momentum going with new case numbers. Thanks, and we'll talk to you next week or next month.
Thank you for joining us for the nation's only weekly podcast, bringing reverse mortgage news to you, the mortgage professional. We do have an audio companion of this podcast, which you can find on Spotify, Apple Music, and Podbean. And of course, do not forget to go to HECMWorld.com if you're not there already. We look forward to talking with you next week and bringing you more reverse mortgage news, commentary, and analysis you'll only find here at HECM World.